It is a pleasure to welcome Robert Lloyd George, who is the Chairman and Chief Investment Officer of Lloyd George Advisory Hong Kong Limited, to Money Talk. You're back in the United States for American Thanksgiving from Hong Kong via London, Robert, and thank you so much for joining us this afternoon.
It's a pleasure, John. I'm very happy to update you on what's happening in Asia and elsewhere.
Now, in the wake of Brexit and Donald Trump's election as the next president of the United States, I want to key off your excellent November 2016 investment outlook entitled A World Remade. Let's start with your reaction to the U.S. results and your impressions of the global economic landscape.
Well, I think everyone is still digesting and trying to figure out what Donald Trump means for the USA and for the world. And I think there's a good deal of nervousness in European capitals and indeed in Asia about his intentions. Day by day, we seem to get new revelations or modifications of his really extreme positions on the campaign, and I think that's somewhat comforting, and it's interesting to see that the U.S. market and the U.S. dollar have gone straight up for the last 2-3 weeks since the election, and I think that this is fine as an initial sort of knee-jerk reaction to the prospect of tax cuts and infrastructure spending and all those good things which will benefit the United States. But my concern really down the road is what will he do about his promises concerning Mexico, concerning Japan and Korea, and of course, most importantly, is China. China has the largest trade surplus with the United States, and I think that he will inevitably have to confront this issue which he raised on the election campaign as to how the United States can balance this trade with China and with Asia. And I think what's already happening is that U.S. interest rates are rising. The Chinese yuan is depreciating steadily against the dollar. And, of course, the pace of global trade continues to slow. So I think that there is some kind of squeeze beginning to happen on Chinese exports and indeed other countries like Korean exports. We saw the bankruptcy of Hanjin Shipping in the summer. I think that was a sign of the pressures and the very weak shipping and trade picture that we've seen. So I think there is a lot of concern. I made the parallel with Herbert Hoover, who was a very successful and indeed a much more successful businessman in his time than Donald Trump, and not only made $1 million from nothing by the time he was 40 in the mining industry, spoke fluent Mandarin, and was a great philanthropist and organized the food supplies in Europe in the First World War. But when he got into the White House, he made one overwhelming mistake, and that was to sign the Smoot-Hawley tariff, which resulted in a spiral of world trade declining very fast within 2 years into the Great Depression. So our great concern is that the America First philosophy, which Donald Trump has espoused, does not result in some kind of protectionist or trade tariff action. And I think if we don't have that, then we may be okay, but it's still uncertain.
Now, interest rates have moved up about 50 or 60 basis points during the past couple of weeks. And I'm just wondering whether the Chinese are selling some of their U.S. treasuries as a bit of a shot over the bow of the U.S.
Yes, I think they are lightening up. I don't think it's a dramatic change. They've been doing that for some time, but obviously the weakening of the renminbi, in a sense, benefits their investment strategy because they do have so much in U.S. dollars. But I think, on the other hand, what we were concerned about, we're looking at all the countries in Asia, and particularly at a corporate level, who's borrowed heavily in U.S. dollars and is now having a double whammy of higher interest rates and a strengthening U.S. dollar. So their domestic business may be weak, and they've got this overseas debt. And I think that's exactly what we've seen 20 years ago in Asia. A sudden strengthening in the U.S. dollar squeezes the debtors. We're being very cautious and selective in the companies that we invest in Asia.
Still, with regard to interest rates, if interest rates go up more aggressively, it really will drive money into the equity markets.
Yes, I think that is the first consequence, John. I think we've had a 30-year bull market in bonds, and that is over. And we are now going to see higher rates of inflation. Some people say as much as 4% in 2017. So interest rates will be up towards that sort of level, 2, 3, 4%. And that is going to put pressure on bond markets, obviously, but also on the United States national debt the interest cost rises, and the European countries, they've also got high debt. So I think that it's a case of, as Warren Buffett said, when the tide goes out, you see who hasn't got their swimming trunks on.
Now, before we move to Asia and the Indian Ocean markets, what are your thoughts on the political shift that is taking place in Europe?
Well, the first earthquake, of course, was Brexit, and the next one was Trump. And I think the aftershocks are continuing. The populist surge, we'll see, I think, Matteo Renzi defeated at the end of this month in his constitutional reforms in Italy. He may resign. I don't know yet whether that means we get a populist party in Italy, but that's the first one. Then we have the May presidential election in France, which looks like being a runoff between Monsieur Fillon, who's a conservative centrist, and Marine Le Pen, who is the populist. And I think, again, the unthinkable may happen, as it has done in Brexit and Trump, that she may make it, and she is in favor of pulling France out of the euro and out of the European Union, by which time the whole thing collapses, I think, by the end of 2017. Now, I'd say the odds are even or slightly less than that happens. And then finally, of course, you've got the German elections in the autumn, and everything hinges on Germany. And since Britain is pulling out, Germany's become even more important to the remaining European countries. I think the euro does not have long before it disintegrates. I would give it 2 years at the outside. How you address Europe in terms of investment, I think nobody has the answer, but some people think the UK may be something of a safe haven. We've had a collapse in sterling from 150 down to about 124, so London's a lot cheaper than it used to be. I still think we'll have London property going down quite a lot. It's a bubble. I think we'll have more unemployment and lots of consequences of Brexit, which people have not yet seen. I liken it to the phony war in 1939-40. You know, the actual result of the Brexit won't be felt for a year or two, but they will be severe. So I'm pretty cautious, really, on the UK and Europe.
Robert, let's go to Asia now, where in these challenging markets, how are you finding real opportunities?
Well, I start with the point of view that trade is going to be difficult. We probably don't want to invest in exporters. We have one or two good names in Japan, blue chip names, and we have domestic consumer stories both there. In Korea, we've got an excellent IT play, and Taiwan. In China, we're very focused on three themes: travel and tourism, healthcare, and education. So consumer preferences in specific areas. We'd be short, if we were able to short, of the old heavy industries, the banks, the oil companies, most of the state-owned enterprises, and, of course, the property sector, which I think is going to correct in China. So that's why I'm cautious on banks. And likewise in Hong Kong. We found some great medical technology companies. Some of them are headquartered in Australia, selling into Asia. There are one or two opportunities in some of the markets like Indonesia and the Philippines, which are growing 6-7% strong, young consumer populations. But the big story is the Indian subcontinent.
Well, early this month, you spent a week in India and Pakistan, and what did you learn?
Well, I'm preparing next week for a $60 million launch of our Indian Ocean Fund, which is 70% invested in India, mainly in mid-cap consumer stories in many sectors. And the other 25 to 30% is in the Asian frontier markets, of which Pakistan is the largest. And I hadn't been to Karachi before, and it was really an eye-opener. A lot of people, of course, feel it's a pretty scary country on the fringe of Afghanistan, and they've had political instability and terrorism in the past. But the surprise on the ground is there are some great companies, well-run, sophisticated management, very much similar to India in terms of demographics. 200 million population, half of them are under 25, very fast expanding domestic economy, fueled by a $50 billion infrastructure investment from China into roads, power plants, pipelines, ports, and that's pushing Pakistan up from the frontier market into the emerging market index within the next 6 months, and the stocks are under 10 times. So we're going to have about 10% of our fund invested in Pakistan, and I think it's a genuinely undiscovered and under-researched market. In India, I arrived on the same day that Mr. Modi had announced he was confiscating every 500 and 1,000 rupee note, which is $250 billion US, or 86% of their money supply. So you might say there was a bit of a shock effect, and there were very long lines outside the banks, and there is a short-term shock slowdown on the consumer spending. But I think it's an excellent thing that he's done in order to clean up the black money and corruption and the criminals and so on that has been a factor of Indian life for many decades. Here is a man with the courage and the honesty to do what was necessary. And one Indian businessman, the chief executive of the Housing Development Finance Corporation, one of the biggest companies in India, said he's the greatest prime minister we've ever had. I said, really? He said, yes, he's greater than Nehru because he's been willing to tackle these fundamental problems. And I think India is looking at the next 5 or 10 years of high growth, low inflation, strong rupee, cleaning up corruption, putting in a new and reformed tax system, and really it's a changing world. And I think that is the greatest investment opportunity that I found anywhere in the world for the next 5 to 10 years.
Now, Donald Trump has announced that the United States will not be part of the Trans-Pacific Partnership.
Right. Well, the general consensus is that it's good for China. I'm not sure I share that because I think what Trump does, as I said at the beginning, in relation to trade with China is going to be much more important than what China does in relation to trade with the rest of Asia, and whether countries like Vietnam or the Philippines or Malaysia or Thailand are willing to give China a more free market access to their domestic markets. I mean, China is the big brother, but it's also the big bully in the region. And I hasten to say that India is the one country that's not affected by this. I think it's a pity in a geostrategic sense that America is, again, withdrawing its influence. The TPP was representative of a more active U.S. role in trade in Asia, and countries like Vietnam would clearly have benefited. But I don't know whether China is going to be able to pull off an alternative. So I'm not sure yet, is the honest answer, how this is going to play out. But I continue to be bullish on the prospects for Asia as a whole because of its huge young populations, free market policies, and general political stability. I think that's always the big risk, when you invest in China or India. Is something untoward going to happen politically? Because the economic outlook is really very strong in that region.
You've been investing from Hong Kong in the Asian region for,
35 years.
35 years. And you have at Lloyd George Advisory a number of funds, and I thought it would be interesting for investors to hear about those offerings on the premise that investors are accredited.
Yes. Well, I mean, I honestly believe that wherever you're based in the world, in the UK or in Canada or in the US, it is worthwhile having, 5 or 10% of your assets exposed to this very exciting and large region. And in my long experience there, I've decided that it's better not to take too rigid approach. You want to take a selective stock-picking approach, and that's what I've done. I invested my own money in this Bamboo Asia fund, which we launched a year ago. We're up around 10%. We've beaten most of our competitors and our benchmark handsomely, and it's really by very nimble stock picking, active use of cash, exposure, diversified across Korea, Japan, Taiwan, China, and Southeast Asia. And then, of course, India, which is a whole different world, and that's why I finally decided that I was sufficiently excited about India that I've moved about a third of my assets into this Indian Ocean Fund. We've raised $60 million, including backing from a major seed investor of the IMF retirement plan and other family offices and foundations. We reckon that fund will grow substantially, and it will have 70% in India and the balance in these Asian frontier markets like Pakistan and Sri Lanka, where we're finding cheap stocks, somewhat illiquid, so it's a very specific product, not for everybody, but I believe the next 5 or 10 years this is going to be a great opportunity.
Now, Robert, for listeners who are interested in your strategies, I would suggest that they can visit my website, johnbudden.com, and if they are accredited investors, I would be glad to provide them with more information and connect them directly with your office.
Okay, well, that will be wonderful.
Robert, thanks so much for joining us this afternoon. This interview was conducted on Wednesday, so I have to wish you and your family a very happy Thanksgiving, and we'll look forward to talking again in the new year.
Once again, John, it was a pleasure. Thank you so much for your time and interest in our Asian investment world.
After the break, we will conclude today's show with Paul Bagnall of our affiliate BNN, who outlines expected earnings from Canada's big banks.